In today's video, I'm going to talk about the difference between going long and shorting a stock. This is very valuable information. It can make the difference between you being a profitable trader or being broke. Hey everyone, lead trainer with StocksToTrade, Tim Bohen here. Going to talk to you about a very important concept and something you need to know. I think pretty much everybody understands the term going long a stock. If you haven't, that means you're buying a stock. You're buying it in anticipation that it will be worth more later that day if you're a day trader, later that week if you're a swing trader, maybe the next year if you're an investor. So you're buying an equity, you're buying a stake in a company, anticipating that that stake will be worth more in the future, and you can then sell that stake, collect the profit, move on to the next trade. So you buy a stock at $1, they announce earnings, it goes to $5, you sell, you made $4 a share, you take your profit, you move on. That is the kind of quote-unquote traditional way to trade stocks. Now, many of you are probably here on this channel or seeing these videos because you're interested in short selling. Short selling is a term you hear about a lot in low-price stocks. The core concept behind shorting a stock is, and I'll elaborate for you, but the idea is that you can make money when a stock goes down. Many people are like, what? How can I make money on a stock when it goes down? Because many of you are familiar with the going long, the buying stock idea. And yes, you can make money when a stock goes down. And it is a very consistent and very often used strategy in low price stocks. But there are dangers and there are things you need to know, and if you're a new trader going into shorting stocks, especially these low price momentum stocks, you can get in a lot of trouble really quickly. So the idea is, when you're shorting a stock, and this is confusing, so I'll kind of try and take it slow, you're actually selling the stock before you buy it back. So it's just like buying low, selling high in the long idea. What you're doing when you're shorting a stock is you're selling high and buying low. I know it sounds really confusing. It's not illegal. It's not unethical. It's 100% legal. It's done every day in the stock market. It's been done since the stock market began 100 years ago. But what you do, you sell first and you have a negative position in this stock. So you have negative 1,000 shares at $5. Now that stock drops, you buy back those shares at $1, let's say, and you collect the difference of that position. So going from negative 1,000 shares to 0 shares by buying those shares back, you collect that $4 a share difference. You would make $4,000 in that trade example. Now, many of you are probably here because you see these penny stocks, these low price stocks, they spike and then a couple days later they drop and you're like, wow, I want to short these stocks. But I want to talk about the dangers and why you need to be disciplined. Remember, when you buy a stock, if you buy $1 stock, you buy 1,000 shares of that stock, the worst possible scenario is that stock goes to 0. That's the worst possible scenario. You lose your entire $1,000. That sucks. Nobody wants to be there, but at least you only lost $1,000. If you short $1,000 worth of a $1 stock and it goes to 2, you're down that same $1,000, but you're not out yet. That stock can go to 2, it can go to 3, it can go to 4, it can go to 5. So now when you're long this big mover, your max loss was $1,000. This stock's now gone from 1 to 5, and we see this every day in these low float and momentum stocks. You're now down $5,000 and you're still not out. And what gets so many new traders is they say to themselves, it's got to come down eventually. It's got to come down eventually. You say to yourself, I've seen all these stocks fail. They all crater. They all drop. It's got to come down. Well, it doesn't have to come down. Remember, if the market wants to push that stock higher, it does not have to come down. And you can be down $5,000, $10,000 on a small position. You can actually end up owing your broker money. Now, most brokers will close you out of the position before you get to that point. But in that scenario, you're still in a bad place because now you've lost money. Your broker forces you out of that account because remember, if your loss gets too big, your broker's on the hook. They'll take you out. You now have a bigger loss, and ultimately you can be right because the stock might crater 2 days later, 3 days later, 3 weeks later, but it does you no good if you're in too early. You get margin called and you get bought in. So those are the two biggest things I want to talk about. Is big thing, if you're new, part-time trader, really look at buying stocks, going long stocks first. But if you're also aspiring to be a short seller, know the dangers, manage your risk, and stick to your stop losses. So I'd like to know, have you shorted a stock? What were the results? Have you done well shorting these low price stocks? Have you been burned? Be sure to comment below and also like, subscribe, and we'll see you on the next video. Hey everyone, lead trainer with StocksToTrade, Tim Bohen here. We'd like to thank you for watching our videos. We really want to help you learn, grow, and evolve and become a consistently profitable trader. We're proud of the tools we built in StocksToTrade and want to help you maximize your success. Be sure to check out the other videos over there, like and subscribe, and we'll see you on the next video.